What are the cities across the United States that have the strongest potential to pay off over the next 10 years? The most important factors are job growth, population trends, supply constraints, infrastructure investment, and overall economic durability. Winning the game of long-term investing doesn't happen by accident. It's a science that is built on real economic drivers. So let's take a look at 10 cities that have the potential to reward buyers and investors who think long-term and buy smart.
Starting with number 10, we have Austin, Texas. Austin remains one of the most talked about growth markets in the country. Even after a period of rapid appreciation and some recent cooling, its fundamentals remain compelling. A strong tech presence, cultural appeal, and continued migration. Austin does face affordability pressures, and new construction has been robust, which may temper short-term price spikes. However, over a decade-long timeframe, markets with sustained job growth and lifestyle demand often regain upward momentum. Investors should focus on submarkets with infrastructure improvements and employment hubs to maximize long-term upside.
Okay, coming at number 9 is Michigan City, Indiana. Michigan City represents a transformation story more than a traditional boomtown. Located within commuting distance of Chicago and benefiting from transportation upgrades, it offers real affordability relative to its neighboring major metros. Investors who target improving infrastructure corridors often benefit first as accessibility increases demand. Lakefront proximity also adds lifestyle appeal that can often elevate long-term values. And this type of market requires patience. But if commuter patterns continue strengthening and local revitalization persists, then appreciation could absolutely outperform expectations over the next 10-year horizon.
Okay, number 8, Lexington, South Carolina. Lexington may not be on every national radar, but smaller southeastern markets often produce steady long-term gains due to affordability and livability. Proximity to Columbia and access to regional employers provide a stable base of demand. For investors, entry prices are significantly lower than in major metros, which allows for better rent-to-price ratios. Markets like Lexington typically appreciate more gradually, but that steady climb can produce strong long-term equity with less volatility. The key risk factor is economic concentration, so watching job diversification trends will be critical over the next decade.
Absolutely. So number 7 is Phoenix, Arizona. Phoenix continues to benefit from both domestic migration and industrial expansion. Major semiconductor manufacturing investments have boosted long-term job prospects, and the metro's relative affordability compared to California has been a powerful magnet. Phoenix does have a cyclical tendency, though. It can run hot and then correct. So investors should approach it with a long-term horizon rather than a short-term speculation. Suburban growth corridors with strong school districts and new infrastructure projects often present the best opportunities. Water supply concerns are frequently discussed, but so far, infrastructure planning has supported the continued development and the population growth.
Okay, we're at number 6, one of my favorite cities, Nashville, Tennessee. Nashville has transitioned from a tourism-driven market to a full-fledged economic powerhouse. Healthcare companies, corporate headquarters, and thriving entertainment sector have diversified its growth story. Over the last decade, appreciation has been significant, but what keeps Nashville attractive is continued population growth and limited housing supply in high-demand areas. Investors should watch zoning regulations and new construction trends carefully, as overbuilding in certain pockets could temporarily cool prices. However, long-term fundamentals, strong job growth, lifestyle appeal, and in-migration still point to steady appreciation potential.
That's right. So now we go to number 5, Louisville, Kentucky. Louisville represents more of an emerging value play compared to the larger metros on the list, but it has a very diverse economy anchored in logistics, healthcare, and manufacturing, and it benefits from central geographic location. Home prices remain relatively affordable, which lowers the barrier for entry, especially for investors seeking better cash flow potentials. Revitalization efforts in certain neighborhoods are beginning to attract the younger professionals, and that demographic shift can signal future appreciation. The key in markets like Louisville is being hyper-local, targeting areas with infrastructure, investment, employer growth, and walkability improvements, rather than just assuming uniform growth across the entire metro.
Okay, number 4, San Diego, California. San Diego may seem like a surprising inclusion given its high entry price point, but scarcity is exactly what makes it compelling. Geographically constrained by the Pacific Ocean, military land, and the protected areas, supply expansion is limited. That natural cap on inventory creates upward pressure on the values over time, especially in desirable coastal submarkets. San Diego also benefits from biotech, defense, and technology sectors, providing high-income job stability. While cash flow investors may struggle due to pricing, appreciation-focused buyers who can hold long-term often see strong equity gains in constrained coastal markets like this.
So to number 3, Tampa, Florida. Tampa has quietly evolved into one of the Southeast's strongest long-term players. This metro has seen consistent in-migration from higher tax states, and Florida's tax structure continues to be a competitive advantage for Tampa. Tampa's economy has broadened into healthcare, finance, logistics, and defense, which gives it a much more stable base than many people realize. Investors should also consider relative affordability compared to Miami and parts of South Florida, which creates room for appreciation as demand continues rising. But of course, buyers must factor in insurance costs and climate-related risks, but long-term demographic trends still favor growth in this region.
Number 2, Dallas, Texas.
Let's go.
Dallas continues to stand out as one of the most business-friendly and economically dynamic metros in the country. Corporate relocations and expansions have been consistent, and Texas's lack of state income tax remains a powerful draw for both companies and individuals. What makes Dallas particularly attractive for long-term investors is its diversity. Finance, technology, healthcare, logistics, and manufacturing all play significant roles in the local economy. While appreciation here may not be as explosive as some smaller markets, the stability and scale of DFW provide durability. For investors, this means opportunities in suburban single-family rentals, build-to-rent communities, and emerging exurbs that will benefit from outward expansion over the next decade. Elias and I are realtors here in DFW. So if you are looking to invest here, we're more than happy to help you explore all of your options. Our contact info is below.
Okay, and finally, number 1, Raleigh-Durham, North Carolina. Raleigh-Durham is one of the most fundamentally sound growth markets in the entire country. Anchored by Research Triangle Park and major universities like Duke, UNC, and NC State, this region benefits from a steady pipeline of educated talent and high-paying jobs in biotech, pharmaceuticals, and technology. So from an investor standpoint, that diversified employment base is a huge benefit because it reduces volatility during economic downturns. Inventory levels have remained relatively constrained compared to demand, which supports long-term appreciation. While prices have climbed over the past 5 years, they're still much more reasonable than comparable tech-driven metros, giving this market room to grow over the next decade.
When we zoom out and look at these 10 cities collectively, a pattern emerges. They all demonstrate some combination of job growth, population inflow, supply constraints, or affordability advantages. The strongest investment markets usually have at least 2 or 3 of those drivers working together. Buyers who focus only on hype or short-term appreciation often get burned, but those who buy in fundamentally strong markets and hold through cycles tend to build significant equity over time.
The most important thing to remember is that real estate is hyper-local. Even within these cities, certain neighborhoods will outperform and others will stagnate while others are booming. Investors should analyze school districts, crime trends, infrastructure spending, employer relocations, and planned developments before making a move. A 10-year horizon allows you to ride out short-term fluctuations, but your entry point and your location selection still matter tremendously. Appreciation is rarely uniform. It concentrates around growth corridors.
Another major factor is financing strategy. Locking in a fixed rate, planning for reserves, and understanding property taxes and insurance costs can dramatically impact long-term returns. Some of these markets, especially in Florida and Texas, have higher property taxes or insurance premiums that must be factored into projections. Cash flow might not always be strong on day one, but appreciation combined with rent growth can create significant wealth over time. Patience and discipline are essential.
Absolutely. And so ultimately, the next decade will reward markets that continue attracting people and businesses. Migration trends, economic policy, and infrastructure expansion will shape where capital flows. And so while no market is guaranteed, these cities have underlying fundamentals that make them compelling long-term bets. If you're thinking about buying for the next 10 years rather than the next 10 months, focus on durable growth drivers instead of headlines, and it will put you way ahead of the curve. And as always, if you're considering investing, especially here in Dallas-Fort Worth, man, we'd love to help you build a strategy that aligns with your goal.